Okay, hi everyone. This is going to be the second lecture on chapter 10. So we finished up last time looking at makers depreciation. We're picking it up now with 179 and bonus. Okay, so let me grab this guy right here, bring it down. Okay, so last lecture talked about makers, that's great. Now we're going to talk about 179 and bonus. Afterwards, we'll move to amortization of intangibles, and we'll finish up with depletion in natural resources. Okay, so what is 179? Well, I said, hey, as a general rule, we have this idea of depreciation, right? You're going to capitalize and then expense over the useful life, but there's these giant exceptions. One of the main exceptions, right? It's like a giant hole, is 179 in bonus. And this says, wow, you would traditionally capitalize this and then recover the cost over time. 179 lets you immediately expense it. When they say 179, that means an IRS code provision, right? That's the rule that says it. Why do they do this? To help stimulate the economy, right? You're more likely to take or buy an item if you get a tax deduction. But there's some mechanics to it you got to be aware of. So basically, up to 1.1 million, right? There's a threshold here. You have to know the exact number. You get to immediately expense. So hey, you put 2 million in, 1.1, you can immediately expense. You put 600,000 into service during the year, you can immediately expense. So it's up to that amount. And the property we're talking about here is generally going to be tangible personal property. Accordingly, you do not get 179 on like buildings, real property. Same with bonus. Bonus is generally going to be for personal property used in a business. So that's the idea. It's number based, right? Up to a certain amount, you get immediate expensing. However, right, once you go above 2.8 million, right, you have to know the exact number, right? For every dollar you go above that amount, that 1.1 goes down by a dollar. Okay, so let's look at 1011 and 1012 here. All right, so 1010, right? This is just showing that 179, this is elective. And what we mean by that is you can pick, first off, you can pick and choose which assets you want to use 179, and you can pick and choose how much 179 you want, up to that 1.1 million. Okay, so here we put 1.2 in, we're electing 800,000. Immediate expense that. The leftovers, right? That's what you're going to subject to makers. You use the table on. You could also potentially subject it to bonus depreciation. But for right now, we're just showing you some of the mechanics. 179 is elective. Oh, sorry, zooming in there. The next thing is, and it's saying 179 is subject to a phase out, right? That 1.1 number, right? That's at the end of the rainbow if everything's perfect. To the extent, right, you go above the threshold, that 1.1 million goes down. So here, right, you put 3.4 million in service, 2.8 is the threshold, you're 510,000 over, right? 1.1 is at the end of the rainbow, you're over 510. Guess what? You're only allowed to get $650,000. That's the idea there with that phase out. And this guy right here, the amount you missed out on, right, how much you're phased out on, you do not get to carry this forward, right? For this limitation, you lose it, you're done with it. All right. the next thing here with 179, right, we talked a little bit about this. It immediately reduces the basis. If there's anything left over, hey, you can hit it with bonus. Hey, you can hit it with makers. But one thing you got to be aware of with 179 is it cannot create or exacerbate, make worse, if you're already in the hole, make it even deeper, a loss. So we call this the taxable income limitation. So at a high level conceptually, right, and we'll see the example here in 1013 because there's some specific mechanics to it. If you were to have $10,000 of income, right, taxable income, and let's say you separately calculated your 179 of 15,000, right, the best you're going to do there is 10,000, right? It can only take you down 179 down to 0. The excess, right, the $5,000 you missed out on, in this case, the taxable income limitation does let you carry it forward. It's in distinction to the separate phase out limitation we just saw. So you need to keep those separately. Let's look at 1013 here to give this some numbers. All right, so it looks like we put 2.4 in. Our max 179 after that phase out, right, the 2.1 million, wherever that lands. Our remaining basis is 1.7. Hit it with makers, 250 of makers on it. Now, here's the deal, right? You have to look at the 179, your taxable income before you take that. All right, so our taxable income here is 400. Our makers is 250. Our remaining taxable income is 149, right? So we got 149 as our taxable income. Our 179, right, which is floating up here, we said that's 650,000, right? But just like we saw, right, in this case, right, you can only take this taxable income down to 0, okay? So that's what it's showing here, right? The best you can do is take it down to 0, 149. The excess, the $500,000 excess, you can carry forward. All right, next one here is bonus depreciation, right? The idea with bonus depreciation is maybe you don't qualify for 179. You're like phased out. So if we go back, right, real quick, just to show you, right, remember I said for every dollar you're above, okay, it's 2.8, that's fine. This guy goes down. What this means, the upshot of this phase out is once you reach roughly 4 million in assets that you put in service, there is no 179. You're fully phased out, right? So like if you're working at a big four firm and you have a large multinational corporation that you're working on, you're probably not going to see 179. They're going to put more than $4 million of assets into service during the year, personal property assets. In distinction, hey, you're at a smaller regional firm, 179 is going to be more prevalent. So in addition to 179, right, they have this thing called bonus depreciation. And essentially what it is, instead of it being a number, right, 1.1 million or whatever, it's a percentage. And right now it's 80%, but it's temporary, right? So when I was in practice, it was 50%, then it went to 100. Per the TCJA, it started at 100 and it's working its way down. We're sort of somewhere in between right now. So bonus depreciation right now is 80%. It's slowly fading away. And essentially, right, what it applies to, it's going to be tangible personal property, new or used, that has a regular depreciation life of 20 years or less. Okay, so you can look at 1014 there to show you that. Here's a good comparison between the two of them, right? So 179, it's a dollar amount, right? It's roughly 1.1 million that you can expense. Bonus is a percentage, right? 80% right now. And again, after you use 179, if there's any leftover basis, remaining basis, you potentially could use bonus makers on that. With 179, right, it's elective. You must choose and opt in. I'm doing it. You can pick and choose on a per property basis. Bonus depreciation and distinction is mandatory. You must use bonus depreciation. If you don't want to use bonus depreciation, you have to elect out of it. And when you elect out of it, it has to be on a property class basis. What that means is, oh, hey, there's a 7-year piece of property. I don't want to use bonus on it. That's fine. But if you do that, then you can't use bonus on all of your 7-year property. So that entire class is now out of the framework there. Next thing, phase out, right? Once you get above that 2.8 number, right? For every amount it goes up, this guy goes down. Not the case for bonus. We don't have that phase out. 179, more of a permanent item there. Bonus, it's slowly fading away, right? It was at 100, 80, it's going to now 60, 40. It's disappearing. At the state tax return level, right? So a lot of times, say you file a federal corporate return, you're going to file a state corporate return. 179 tends to be on both of them, right? A lot of states adopt Section 179 as a tax provision. However, bonus, not so much at the state level. Finally here, an NOL, can it create a loss? 179, no, it doesn't let you. Bonus, it does let you create a loss, okay? All right, let's just talk briefly here about listed property. So this is essentially property that's conducive to both personal and business use. And essentially with it, right, and let's just assume, and it's safe to assume that you're using it more of 50% of the time in the business, right? I'm using it 70% in the business and 30% personally. How do we deal with this, right, with listed property? So if we go to 1015, right, we have a person here. Looks like they buy a camera and they use it 75% in business and 25% for personal use, right? So that's greater than 50% of the time. What you do here is, and let's just assume we're using makers. For year one, you figure out the full year of depreciation. Then you multiply it times the business use percentage. In other words, they're not going to give you a deduction there for the personal use amount. All right, so listed property gets more complex with 179 and bonus depreciation. What I would say is, read over this once, look at it. These luxury automobiles, they get complex. Don't get too caught up in listed property. I'm less concerned about these very nuanced points for it. Next thing here, right, and again, we've seen AMT before in passing. Just be aware how you calculate depreciation for the regular tax formula is different for how you calculate it for AMT. And specifically the difference, a lot of times what it comes down to is, are you using 200% declining balance or 150% on AMT, okay? All right, let's move to intangible property, right? So if we depreciate tangible property, then we amortize intangible property. And as a general rule, right, we're going to amortize intangible property over a straight line method, normally 180 months, i.e. 15 years. But how we deal with this, right, it depends on how we got the property, right? We're going to have 4 scenarios, right? So 1, 2, 3, 4 that tell us how to apply amortization rules. So let's look at these. The first one, right? So it's a section 197 intangible. What this means is, right, one business, let's say Amazon, right, they're going to acquire Whole Foods, right? I don't know, let's just say they pay $1 million, right? Some of the stuff they get from Whole Foods is going to be tangible assets, and some are going to be intangible assets, right? So let's say 700 are tangible and 300 are intangible. In this situation, when we have one business that acquires another business and they get intangibles as part of that deal, we have to amortize those intangibles straight line over 180 months or 15 years. And in this way, we're going to use the full month convention. And that basically says, hey, regardless of when you had this acquisition, right? If it was on the 1st, the 2nd, the 3rd of the month, the 29th, we're going to give you a full month up front. And then, hey, in the year of sale, we'll give you and we'll satisfy the convention then. Okay, so just be aware of that. There's the full month convention. If we look at 1020, this gives it some numbers here. All right, so we have, it looks like section 197 intangibles, right? So we have one business that's acquiring another business, Amazon acquiring Whole Foods. They paid 350 grand, 225 are for purchased intangibles, right? And specifically that 225, right? It's these guys right here, a patent, customer list, goodwill. Well, hey, what we do is pretty straightforward, right? $25,000 was the patent, divide it by 180. There's our monthly amortization over 180 months. Section 197, one business acquires another. To the extent there's intangibles, amortize them straight line over 180 months. All right, the next setup, right, where we talk about intangibles and amortization is when we're looking at organizational and startup costs. Now you got to keep these separate, right? What I mean by that is they're two separate things, like two separate buckets. What do we do here? What's the framework for analyzing them? Well, essentially, step one is we're going to identify what they are. Step two is you can immediately expense $5,000 at the end of the rainbow. There's some phase outs for each. And anything that's left over, you amortize. Okay, so this is how that links up into amortization. But let's kind of look at these here. First off, organizational expenditures. We're in this bucket over here. What are these? Well, these are essentially those costs you would use to form a business. Hey, you pay the state some fees. Hey, you pay an accountant. You pay an attorney, right? One thing that doesn't count are syndication costs, right? So maybe I'll put an ad in the newspaper. I'm starting a business. Please buy our stock, right? I'm trying to sell or market our stock. That doesn't count as organizational expenditures, right? So I don't know. Let's say that we had $15,000 of organizational expenditures. That's great. What we then do, and we'll talk about the mechanics of it, 5,000 of that we're going to immediately be able to expense, right? The remaining 10, right? So 5 will expense. The remaining 10 will amortize over 180 months. But this is where it gets tricky, right? And it's not that hard. 5 is at the end of the rainbow. That's if everything is perfect. In other words, it's going to be subject to a phase out. And what it says is, to the extent you have organizational expenditures more than $50,000, right? Then that 5 goes down dollar for dollar, right? So I don't know. Let's say we had 52,000 in expenditures, right? 5 is the magic amount, right? So we're over 50, right? So 51, 52. We went over by 2, so this has got to go down by 2. In other words, we're only allowed to expense 3. So anything that's left over, right? So we had 52, and we said 3 of it we're going to immediately expense. The leftover, in this case 49, will amortize. Right, so this is kind of a good analysis here showing you what's going on. If your amortization costs, right, step one, identify them, right? Hey, we're at 15 grand of amortization costs. Well, hey, that's less than 50. You get to expense 5, 10 that's left over, you'll amortize. If you're somewhere in between, right? We said 52. We went back here, right? We said in this case, you're going to be subject to a phase out, right? In this way, you'll be able to expense 3. And if we go back here, right, 49, you'll amortize over 180 months. Finally, right, if you're over 55K, let's say you have 60,000 of organizational costs, well, you don't get any immediate deduction. In the 60,000, you just amortize over 180 months. So let's look at examples 1022, 1023 here to give this some numbers. All right, we got a business with 53,000, right? We said 5 is the magic number you could immediately expense, but that's at the end of the rainbow. They're over that amount, right, by 3. So we got to reduce the 5 by 3. So 2 is what we immediately get to expense. Well, if we have 53, and we said 2 we're going to expense, then that means 51 we have to amortize. In 1023 here is just showing us how we'd amortize, right? You divide it by 180 months, 283 per month. Looks like there were 11 months this year, 3,100 for our amortization expense. All right, the next thing are startup costs, right? And with startup costs, these are a separate bucket. What are they, right? Well, they're essentially going to be the cost for creating or acquiring a trade or business. Things like determining whether to locate a business in a particular city. So by way of example, right, if I came up to you and I said, hey, I'm starting a new business, I hired an accountant for $2,000 and I spent $1,500 to travel to Dallas to see if that would be a good place to run the business. Well, what you would say is, well, that's the accounting fees, that would be an organizational expenditure. And the traveling to Dallas to see if that's a good place to have your business would be a startup cost. And with startup costs, you also get $5,000 you can immediate expense. But again, it's going to be subject to that same threshold, that same $50,000 phase out. So a lot of times, like I said, people collapse these and they think they're one and the same. You got to keep them separate, right? It's like you get $5,000, you get $5,000, like Oprah, right? You get a car, you get a car. But within each of those buckets, you got to run the framework. You got to run the numbers. How much of that $5,000 are we allowed to use? Whatever the leftovers are, right? That's what we're going to amortize over 180 months. Okay, so that was the second scenario with intangibles. The third scenario would be research and experimentation. And this basically says, hey, if we're incurring research and experimentation costs, maybe we're working on a patent, we're working on a drug, right? Generally, and there's very specific codes on this, you're going to have to capitalize those costs and amortize them over a 5-year period, the 180 months. Okay, so 180 months for that guy. Finally, right, say that you purchase an intangible, and this is just a regular purchase, right? It's not a 197. 197 is when one business buys another and there happens to be an intangible. This purchase, when they say it, is just like, hey, I'm a pharmaceutical company. I want to buy a copyright to the song. I'm not buying that whole other business. I'm just buying the copyright. That would be the scenario here. In this case, you amortize straight line, but it's over the remaining legal life. So that could be different than 180 months when they say legal life. So I don't know, say that you buy the copyright for the song, right? And it has 10 years left before that copyright's gone. Well, you amortize it evenly over the remaining legal life. It's not necessarily 180 months. Okay, so this is just kind of showing you here, a good summary of it. And then finally, we're going to round things off with depletion. And the idea with depletion is, right, so you have real property, right? You buy a house and a business. You don't immediately expense that, right? You kind of recognize it over time through depreciation. Hey, you buy a copyright, right? You do not immediately expense that. You amortize it over the life. With depletion, what we're saying here is you buy a natural resource, right? So maybe you buy a Christmas tree farm, right? It's a bunch of Christmas trees on there, all right? Or you buy an oil well or a gold mine or something. You do not immediately expense that. You have to recognize the cost over time. But depletion, in this way, time is not the factor that drives the cost. And what I mean by that is it's kind of like units of production. In other words, the passage of time by itself does not generate depletion. Instead, to the extent you rip it out, right, and you sell it. So, right, in year one, we ripped out 2 Christmas trees and we sold it. We're going to have, a depletion expense there. Year 2, we don't do anything, no depletion expense. Year 3, 3 of them we rip out, right? So we're going to get 3. So you can see it's kind of like a function of how much you rip out and you sell it, okay? Now, when we're talking about depletion, the IRS says we're going to give you 2 ways, right? You can pick depletion. You can use cost depletion or percentage depletion. They give you 2 methods. And generally, right, you're going to pick the bigger of the 2. Let's start with cost depletion, right? Cost depletion. And what they say here is, all right, hey, you buy that Christmas tree, like the tract of land, you got to estimate how many Christmas trees you're going to get out of there. And then, right, once you assign a cost to that associated with that estimate, you're going to multiply it times the number of units sold. So let's look at 1026. This one's easier to explain through numbers. Okay, so we got a guy, right? They buy a gold mine, 1.5 million. They say, hey, we estimate that we can pull out of this guy 1,000 ounces of gold. All right, during the year, we rip out and let's just say we sell 300 ounces of gold. How do we figure out what our cost depletion is? Okay, so what we do here, we say, okay, we paid 1.5 million. We think we can get 1,000 ounces out of it. Accordingly, each one of those ounces costs us 1,500 bucks. During the year, we pulled out 300 ounces. Accordingly, our cost depletion will be $450,000. To the extent, right, we pull it out, we get the depletion expense. Okay, that's the idea here. This is one way. It's the first option, cost depletion, just a little bit of math. The second way is percentage depletion. And essentially here, what the IRS says is, hey, you got to take the gross income from that Christmas tree farm, from the gold mine, right? And then multiply it by, right, so your gross income, which is like your total income, times a percentage, right? That will give you your depletion. We'll see it's subject to a constraint. But just to keep it simple, right? I don't know, let's say you had $100,000 of income, gross income from this gold mine, right? So it's gold, hey, 15%. Our depletion, our tentative depletion is $15,000. Okay, that's like the starting point. But there's a constraint, right? We calculated $15,000. What the IRS says is we have a taxable income limitation. In other words, your depletion that you actually take, what actually hits the tax return, cannot exceed, let's just say 50% of taxable income. So in this way, right, we said our gross income was 100. Let's say our taxable income is, I don't know, 20,000, right? What's the difference here, right? This is your total income. This is kind of like your net income. We're backing out expenses, right? Yeah, I got 100,000 in cash, but after I paid my employees, after I got the machine, right, I only pocketed $20,000, right? So 50% of that, right, because that says 50%, is 10. What this means, right? We originally calculated 15, but the best we're going to get is 10, right? We're limited to 50% of our taxable income. So let's look at a final example here. Okay, so we have that gold mine, right? They're telling us our gross income in year one is $2 million. It's gold, right? So it's going to be like Gold Member from Austin Powers. Gold, he loves gold. I can't remember how that guy talks, but he's like kind of stupid. In any event, right, 2 million times 15%, hey, that's what we originally calculated. That's great. But we know, right, that we have this constraint, right? So there's our taxable income. Multiply that times 50% to 50 down here, right? So we calculated 300, but the best we're going to get, our constraint, is 250. Accordingly, under percentage depletion, our deduction is going to be 250. The last slide here, this is just saying, hey, remember, you pick, you get the choice under the IRS of cost or percentage depletion. As a general rule, you should calculate both and pick the bigger of the two, right? Year one, that's bigger. Bigger's up there. Bigger's down there, right? The bigger the expense, the less taxable income. So that's it, right? This is the end of chapter 10. We'll see you in the next lecture.